BlackRock's Rick Rieder was with me yesterday on Closing Bell, and he revisited what he told me several months ago about how he sees the backdrop right now. Listen.
I'll never forget the interview we had. We said this is the greatest investment environment I've ever seen. I still hold to that.
You do?
Yes, I think it's a great, but I think what you're going to see now is much more volatility.
Okay, much more volatility, and maybe we're seeing some of that. Maybe some of it's self-induced by the Trump administration. The thing with Chair Powell obviously has made some people uneasy. What do you do in light of that and what could be a more volatile environment?
Well, it won't take much to see volatility increase. We just had 3 straight years of double-digit growth in the S&P, up 16% last year, 23% in 2024, and in 2023 we had 24%. So the expectations are high, the valuations are rich for the broader market overall, but the economy is gaining steam, clearly, at 5% in Atlanta Fed tracker. Consumers are doing their thing. They're consuming. AI, the momentum is still there. It's not going away. I do not believe 2026 will go away. I do think also you're seeing massive productivity gains. This is the big change for me, Scott. I mean, we haven't seen numbers like this in decades. I mean, we were growing productivity like 1-2%, 4.9% in the most recent quarter. Unit labor cost down 1.9. That is very, very healthy. And the productivity number is actually pretty good for inflation expectations. So add it all up, double-digit earnings. Going away from technology, though, that's where the expensive stocks are at. You clearly see the rotation happening, and I'm there, you know that, and I'm adding to them. We're going to talk about some of the things that I have been adding to, because I have conviction in the underlying strength of the economy. So volatility increases, use it to your advantage and buy on dips.
Josh, do you believe what Rick Rieder had to say again yesterday, that this is the greatest investing environment?
Greatest might be further than I would go, but Rick is very bright, and I wouldn't disagree with him materially on just the overall positive backdrop. You have deregulation with an occasional insane tweet. That's really powerful. It's hard to quantify, but people are taking risks, and people are going into new businesses, and there's tons of M&A that you actually can qualify. It's a great last 12 months for M&A. You've got IPOs back. We'll get SpaceX maybe by the end of this year. I don't know. Is that $1 trillion IPO? Maybe you'll even get OpenAI. Is that $500 billion, $750 billion? I have no idea. Like, you can't look at a backdrop like this and say it's not a good environment. The real question is, are we already pricing in how good it is? And that's like the main debate. But look, I listened to the JP Morgan call this morning, and I know we're going to get there in a second. This is the CFO. Consumers and small businesses remain resilient, continue to monitor leading indicators for any signs of stress. Despite weak consumer sentiment, trends in our data are largely consistent with historical norms. We're not seeing deterioration. So people are not happy with the price of things. We all get that. That's what the midterms are going to be about in a few months. But at the end of the day, they're spending with abandon. Delta is making more money in the front of the cabin than the entirety of the main cabin of the plane. It's K-shaped, it's this, it's that. In the end, revenues are going up. Profit margins will be 14, 15% this year for the S&P. Rates are either flat or maybe even lower. I don't know how you could argue with Rick materially that it's not a good backdrop to be making investments right now.
Jimmy, I'm glad Josh brought up the Delta information. It really is amazing when you look at it. The main cabin, okay, that's everything below first and business class, was down 7% year on year. Premium, which is first in business, was up 9%. Yeah. That screams K-shape. It represents what the greater economy has looked like. Not commenting on the Delta number specifically here, but what about the backdrop? You do have this, I think it's fair to say, this self-induced volatility. Now, when you had the self-induced volatility of Liberation Day, that was short-lived because parts of the market got unsettled to the degree that the administration became unsettled looking at the market, becoming unsettled and the prospect of it getting even worse. Some are warning that the attack on Powell will backfire on those who want cuts. Obviously, there's the issue of what the bond market may do. Stiefel says the S&P is going to consolidate around 7,000. Why? Because the, quote, emotional security blanket of rate cuts looks frayed. Schwab talks about today, buy to rate cuts. And then you have Wolf. We see several triggers on the horizon that could potentially spike bond volatility higher, including further worries about monetary policy and Fed independence. What do you think?
I don't think we need rate cuts. And I know there's a perception out there that the stock market is counting on rate cuts. I think that the market can fly without rate cuts because if we don't get them, it's for the right reasons. It's because the economy is growing. Stephanie, you just went through what the Atlanta Fed GDP is tracking, 5% for the fourth quarter. And in the third quarter, it was 4%. We've got unemployment at 4.4%. And we got CPI today, which was really quite benign. I mean, I think the core was 2.7, maybe it was 2.6% year over year. I'm perfectly fine with that. Now, I'm not saying we won't get rate cuts because it's too early to determine that, but I really don't think we need it. We've got tremendous fiscal stimulus coming from the budget bill. And what if, as is presumed to be the case, the Supreme Court overturns tariffs? What if they mandate that the tariffs have been collected, have to be refunded, and another $200 billion comes flooding into the market? You know, Josh said, and I agree with him, that, you know, the good news may be priced into the markets, but there may be a absolute waterfall of money coming into the economy that will goose this market and this economy higher. I don't think we need rate cuts.
You didn't address, though, the issue of Powell. No, no, the issue of Powell and Fed independence.
Yep, let's hit it.
I don't. What do you think? I mean, is it a binary deal? The market's trying to look past it, not necessarily believing that it's going to go anywhere. However, if it's a Powell indicted market does something really bad, Powell not, then the market just blows it off. I mean, how do we think about it?
I think that the comments that were made yesterday by Ben Bernanke, Janet Yellen, Robert Rubin, and everybody else were right on the money, that in the long run, this does make us look like an emerging market economy. But I stressed just there, in the long run. This is a market right now that's focused on the short term of everything that I just said, profit growth, economic growth. In the long run, it is a very bad idea to bring the chairman of the Federal Reserve under investigation. Because what it does is it says to anybody else on the board, whether you're the chair or a governor or a Federal Reserve Bank, that if you don't toe the line, you are likely to be the subject of an investigation or fired, like Lisa Cook.
Yeah, the market is ignoring it.
What I just said.
For now.
What I just said.
Market's ignoring it for now.
The short term, the market is focused on economic growth, profit growth, low unemployment, stimulus, potentially tariff rebates. But in the long run, this will matter.
And he's not going to be around in the spring. He leaves. So why are we even debating it?
Because some are suggesting that he may not leave altogether.
Even if he doesn't
leave. And that could be an issue because then the administration wouldn't get the seat that they so covet to further, at least in their minds, guarantee
you're going to have a more dovish Fed. You're going to have a more dovish Fed. There's no question about it. And
you don't care about this issue at all?
At all. Not at all. I just want them to get rates right.
Can't afford to.
We talked about this last time I was on Closing Bell. I mean, I just think they haven't gotten it right in so many years in terms of rate cuts or rate raises. I mean, so to me,
the Fed?
Yeah.
I don't understand. Like, what do you mean they haven't gotten it right in so many years? The whole reason why you are bullish, in part, on the picture right now is because you can make the argument that they may have gotten it wrong at the beginning, but they've certainly gotten it right since.
I think that
inflation's low and the economy's good. What more do you want?
And I think that they can cut because we don't have a housing cycle. We need housing to recover. And if you don't have a housing cycle, you don't have an auto cycle. And it's remarkable that we're growing 5% without those two big components. You need those two to actually recover. And lower rates is the only thing that's going to help that.
Joe.
Monetary policy is easy. It's getting easier around the world. To Rick's comment, as far as this being the greatest investment environment, from an asset allocation perspective, he's 100% right.
And they are the largest asset manager in the world.
And in 2025, we had a paradigm shift. You had the opportunity to invest in what was underappreciated and non-appealing type of assets, whether it was investing in developed international, emerging market debt, or back here in small caps. So that opportunity creates a much healthier environment. As it relates to volatility, there's different types of volatility. The volatility environment that's most challenging is when capital exits, because when capital exits the market due to volatility, it doesn't return.